Hello, everyone. It's Professor Reiko here. We're continuing on our chapter on accounting for income taxes, and we're dealing with deferred taxes. So our first video, we just did an introduction, kind of introduced some of the key terms that we're going to use, and now we're going to start putting some numbers to things. All right, so let's look at this example here. I've got two examples on this video, one for an asset, one for a liability. So let's just run through these real quick. All right, so we got a company. They earned revenues of $30,000 during 2016. They have no other expenses other than income taxes, so maybe not realistic, but just trying to keep things simple for this first example. Assume further that income tax laws specify that income is taxed only when it was received, meaning when the cash actually changes hands. All right, so it says they received $10,000 in cash during 2006, and the remaining $20,000 will be collected in 2017. So think of that remaining $20,000 as just some sort of receivable that we'll collect later. The income tax rate is 40%. All right, so we've got some questions here. Let's just run through these real quick. It says, what amount is reported as net income before taxes? All right, so remember, income before taxes is our financial income that we refer to in this chapter. All right, so what is that number on the financial statements? All right, well, I mean, we can see pretty straightforward. We have revenues minus expenses equals net income, or maybe I should scratch that out and put FI here because we're just going to be income before taxes. And we had 30,000 of revenue. So remember, all 30,000 is going to be recognized on our financial statements. We said there's no other expenses other than taxes, so our financial income is also going to be 30,000. All right, so it also says what's amount is going to be reported as taxable income on the tax return. So remember, we're comparing this financial income and taxable income. All right, so in taxable income, remember, it says we recognize it as revenue only when it is received. So we'll have 10,000, no expenses. So taxable income is 10,000. All right, so what is the tax payable on this amount? So remember, the income tax payable that's going to go on our balance sheet and be part of our journal entry is just always taxable income times the rate. All right, so that amount is 4,000. All right, so we see here we have 30,000 financial income, 10,000 taxable income. All right, so remember the rule we talked about in the first video. We're comparing taxable income to financial income. So taxable income is 10, financial income is 30. All right, so we can clearly see that taxable income is less. So let's walk through this. All right, if taxable income is less, that means we're paying less now. We're only paying 4,000 right now. Okay, so if we're paying less now because of a temporary difference that we expect to reverse out in the future, that means we will pay more in the future when that reverses out. All right, so think about it. If nothing else happens, come back up here to the top and look. If this 20,000 is collected next year, it will be revenue on the tax return. Let's say nothing else happens. That means there will be zero financial income and 20,000 taxable income. So then you'll be paying more. All right, so taxable income is less now. All right, I'll circle that so you don't think less than equal. Circle that so it's less than. So we're paying less now, which means we pay more in the future. So it is a deferred tax liability. All right, now remember, the deferred tax liability is the tax on the difference. Okay, so my difference here is 20,000. So make sure you remember that. The DTL is not 20,000. It is the tax on that difference. So the 8,000 is my DTL. All right. So coming down here to put it all into journal entry format, and then we'll look at what it does on the income statement. So my journal entry, I mean, if you think about what happened during the year, I can probably squeeze all this in. All right, here's the journal entry. We received cash of 10,000, sorry. We had a receivable of 20. And then we'll just call this sales revenue of 30. All right, so there's the 30,000 of revenue that we had. This cash that was received was counted as revenue, so 10 of the 20 was on the tax return, and the receivable is what's left over. That's our difference. All right, and then so my journal entry. So remember, on the first journal in the first video, I said, you know, your journal entry, we're going to have deferred income tax expense, DTA or DTL, or both, as we get a little bit more in depth later in some of the videos, and income tax payable. All right, so we already calculated the payable, it's 4,000. We calculated the DTL, it's 8,000. And then remember in the first video, I said this number is always a plug. All right, some of you might be saying, well, I could have taken FI of 30 times 40%, gotten 12,000. Well, that is a factual statement. However, when we start getting into examples where rates change and things like that, that will no longer hold. So I just get into the habit of defining it as the plug number, meaning it's the net of the current and deferred. Remember, this is the current and this is the deferred. So the net of those is 12,000. And that's what the income tax expense is. All right, so my income statement would look like this. We'd have revenue of 30,000. So remember, that's what we did at the top. So we had revenue less zero expenses gives me income before taxes of 30. All right, so my income tax expense, remember, is made up of the current and deferred portion. So it's 12,000. All right, so that 12,000 right there needs to match this 12,000 up here to make sure you have the same thing. So net income will end up being 18,000. So that's after taxes. All right, so let's switch over to this next page here. Excuse me. And let's do another example that's going to end up with an asset. All right, so we've got a company here. This is dealing with warranties. All right, so they had cash revenues of 60. So that means we're not worried about like we had in the previous example because it's all in cash. All right, you can see here they offer a warranty on their service. All right, so no warranty claims were made in 2006. But they estimate that 2007 warranty costs of $10,000 will be incurred that relate to the 2006 revenues. All right, so remember, with warranties, we want to match the expense in the period of sale, which means we're going to expense the $10,000 in 2006. All right, but notice here the $10,000, this is what I was saying, is warranty expenses reported on the financial statements, but not deducted as an expense for tax purposes because you don't deduct it until you actually do the work in this example. All right, so what is the amount to be reported? So remember, just like the previous one, we have revenue less expenses equals 50,000. Now remember, this is going to be my financial income, income before taxes. On my tax return, however, it's 60,000, and we're not expensing anything, so my taxable income is 60. All right, so 60,000 times 40%. Is 24,000. That's my income tax payable number in my journal entry. All right, so remember this rule. All right, let's go through this. All right, remember, just like the previous page, we're comparing taxable income to financial income. All right, taxable income is 60. Financial income is 50. So taxable income is greater. So if taxable income is greater, that means we're paying more now, which means we'll pay less when it reverses out. So this is a deferred tax asset because we're going to be able to pay less in the future because we'll have future deductible amounts. All right. So remember, don't forget the DTA is the tax on the difference. So my difference is 10,000 times the 40%. That gives me 4,000 as my DTA. All right. So my journal entry would be income tax expense. I'm not going to write out the warranty journal entry and all that. But we'd have income tax expense, we'd have a deferred tax asset, and we have income tax payable. So the journal entry to record your taxes is going to be similar every single time. All right, we calculated that as 24. The DTA was 4. And remember, this income tax expense is defined as the net of my current, which is the payable, and deferred, which is the DTA. So that's 20,000. All right, and so that DTA is going to reduce my income tax expense, as you can see there, down to 20. So we need to do the same thing down here when we do our income statement for this. So remember, we had revenues of 60. We had warranty expense of 10. So we have income before taxes as 50. So remember, income before taxes is my financial income. All right, my income tax expense is the current portion is 24. Remember, a deferred tax asset reduces income tax expense. If you ever get confused here, just make sure this number right here matches the 20,000 in my journal entry up there. All right, and then that means my net income for this problem is 30,000. All right, so these are just a few kind of easy examples to get us started. We'll add in more complex examples. We'll start changing rates. and things like that. We'll talk about valuation allowances. So there's still a lot to come up, but we got a pretty good foundation for this chapter that we can now start rolling through some more complex examples. All right, so I hope you enjoyed this. Hope this helped you understand your deferred taxes a little bit better. So please subscribe to the channel. It does help me. Please share with your friends. Hopefully it will help them as well when they're reviewing for their exams. And be sure to tune in next time as we get into a little bit more depth. All right, thanks.